We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Jensen, mining executive and metals analyst. How are you today, David?
I'm great, Tom. Good to be back with you again.
Always good to have you. We always have quite an interesting chat, and I don't think today will be any exception to that. David, I wanted to start by kind of getting a sense of this time in the metals right now. You know, we've seen this rise over, let's say over the past 4 years, and then over the past since the beginning of 2024 here, and being over this $2,000 level. We've gone through periods in the metals markets where they have been very range bound and really low volatility. Comparatively, we have seen over the past couple months, and especially the past couple weeks, a very volatile gold and silver price, both to the upside and downside. So can this volatility show us that there is market stress?
Yeah, I think it's an indicator of the innate shortage that we have in the market, that physical supply is becoming an issue. And I think as a consequence, when shortage shows up in the market, it absolutely kills the ability to set the price with these promissory notes that they use in London, which is the world's primary gold and silver market, has been for decades.
Well, reading through your articles, there's a couple different mechanisms that exist here. So you mentioned London and the promissory note. So explain to us how that works, and if there's any possibility to understand how many times this metal can be rehypothecated.
Yeah, so the London market, if you read some of the old documents out of the LBMA, the London Bullion Market Association, you start reading some of their documents, and you read comments from traders that they sold 40 bars, right? They refer to buying and selling bars, the 400-ounce bars, which are the good delivery bars for gold in London. And what happened in 1986 was that the Thatcher government had what was called the Big Bang financial reform legislation that they put through. And part of that legislation was it gave oversight of the London gold and silver markets, which are 90% of the daily trade globally or have been for decades. It gave control of that to the Bank of England, who are the money printers. And we have to keep in mind through all this discussion that gold and silver have historically been the warning system of when, this animal spirit sees the central bankers and they run, they open the spigots and they run loose monetary policies for a prolonged period, which results in price inflation. Mm-hmm. And there's a historic document that Keynes developed the theory, and even Larry Summers wrote a paper on it. And it was Gibson's paradox. And it was that interest rates were driven not so much by the rate of inflation, but what was called the price level. And the price level can be best indicated by how high the price of gold is at any one time, but it's also, in general, the level of prices in general in society. And so during the 1970s, the price of silver ran up by 24 times and the price of gold ran up by 21 times as price inflation ran in the economy. So they quickly recognized that to take away this limiting device, that they would just convert the trading of gold and silver into promissory notes, which is what happened when the Bank of England took over the markets. So in 1987, the LBMA was created by the Bank of England, and they started trading promissory notes in the spot market, which itself is 90% of the daily trade in London. And the spot market is a cash market, immediate ownership. I have a spot market certificate. I own a bar in London, and they traded promissory notes. And as a consequence, there was no limit on the amount of gold and silver they can trade every day. So when you look at the trading in London, like the LBMA, go ahead.
Before we continue, what order of magnitude is it, the amount of promissory notes that can be traded versus the amount of actual available metal?
There's no limit. Mm-hmm. The realistic limit would be set by the amount of people asking for bars. Mm-hmm. So as long as you've got enough bars in the vault, you can issue as many of these paper promissory notes as you want, as long as you've got sufficient bars in the vault to meet them.
Right.
As soon as you see physical shortage, that kills that trade. That kills the ability to issue promissory notes because you run into the problem of default. People come to you with their warrants and say, okay, I'll take the bar. And it's like, well, I was only kidding, right? I gave you a gold and silver a spot contract, but I don't actually have the metal. Well, then you've got open default in the market, and then you lose control of the paper pricing system because right away, everybody's going to start to demand physical delivery. And sorry, Tom, just to give you a sense of how crazy the volume is, it's traded in London in this market. So the London market is about 90% spot trading. So the LBMA issues stats monthly on their trading, and they're averaging about 20 million ounces a day of gold and 292 million ounces of silver per day on average. But that's only part of the story, because we know from the 2011 the LBMA did a survey in 2011 of all the major bullion banks, and with only 2/3 of the bullion banks responding, and we don't know if the biggest ones responded or not, the LBMA estimated that the true volume was actually 10 times the volume that they post on their website every day, the net settled. So if you buy 15 contracts and sell 10, you've traded 25 contracts, but they put in 5 because you've bought 15 and sold 10. So the net trade is 5. Mm-hmm. And so the true daily volume in London is 200 million ounces of gold and 2.9 billion ounces of silver per day that they're trading in this paper promissory note market. So when you look at like 2.92 billion ounces of silver trading every day, that's 3.5 times annual mine supply that they're trading every day in London. Like it's just completely off the rails. And I think what we're seeing now in terms of this issue of the silver in China, and I've touched on that in my articles, is that there is now sufficient shortage of silver in the global market that the bullion banks who have been shorting this metal to contain it are now desperately seeking sources of physical metal so that they're not defaulting. I think that's the key issue.
Mm-hmm. Well, I want to get to talking about maybe symptoms of that show us that. But when we're thinking about the price action that we've seen within the last week here, where silver was up over 6%, how does that affect these bullion banks that hold short positions in the metals? Do price jumps like that push them into covering their positions?
Well, it should, as long as they're not cash settling. And the issue is that the London market, it's an OTC market, over-the-counter market, and every contract is different that's traded in London. Mm-hmm. But there's likely no cash settlement mechanism in those spot contracts that they're trading in London. And I think that's the key, Tom, is that the bullion banks have been issuing these promissory notes in the market. And there's really 2 mechanisms. One is, we can touch on that in a second about the ETFs. They've been rehypothecating client silver into the market. And the second way is just by naked selling spot contracts into the market and then facing a claim on the contract. Mm-hmm. So those are 2 different mechanisms for issuing these spot contracts into the market, which are naked. And then now, like this year, we have a estimated, and the Silver Institute numbers, like there's issues with them, but just it's the best number that we've got, but it's about 265 million ounce silver deficit this year in the market. And we've had 1 billion ounces over the last 6 years that have been in deficit in the market. So we can see the shortage coming into the market. And now these bullion banks are facing this problem, is that they've been issuing these spot contracts into the market. And now they're starting to see at the margins, because of the large deficits that are being run in the market, they're starting to see demand for delivery of metal. And this is what is driving this. All of a sudden, they start popping up in China trying to secure the metal.
Well, that's exactly what I wanted to get to, was this idea that, or the news that some of these big 4 bullion banks have actually visited there.
Yeah.
So is that a symptom of, as we were kind of touching on, you think their inability to get metal, physical metal, to back a lot of these contracts at this point?
Yes, I do. I mean, one key aspect to this is that comment by Jeff Currie that was made about 3 years ago, where he was on CNBC. Mm-hmm. And Jeff Currie was the head of commodity research for Goldman Sachs. And he said, it's impossible for retail investors to move the price of silver because they buy ETFs, exchange traded funds, which buy the metal. And he says, but the ETFs themselves are the shorts. They sell the metal he called it hedging, but he says they turn around and sell the metal into the market once they've bought it and held it for their clients. And the issue is we don't know where they've sold the metal. If they sold it in London, they've likely sold it into the spot market where there's a claim for metal. And now with these continuing deficits, they're likely seeing this increase in demand for delivery. And they've got a real problem now, is that the paper trade works well as long as nobody demands the metal. You can create artificial supply and say, yeah, we've backed it with a bar. But then when you have a shortage, people say, okay, I've got your warrant here for delivery. I'll take the bar. And now you're in trouble, right? As these ETFs are, because you can sell claims, rehypothecate. It's called rehypothecation, but you can sell claims against your client's metal, which is fraud, by the way, and it's illegal. But once you start losing the metal, the gig is up, right? Because you're going to have auditors looking into your vaults in terms of, is there actually metal there? Not necessarily how many claims are against it. And also, once you open the door to rehypothecating metal or creating claims against your ETF metal that's held in the vaults, there's no limit on how many claims. You could create 10 claims per bar. Right. And the risk there is the leverage that's in there is that you only need a small percentage to start saying, we'll take delivery, at which point you're in desperate trouble. So, yeah, we are seeing these, the Chinese Shanghai Gold Exchange has been posting photos of these bullion bankers showing up at the Shanghai Gold Exchange in China. And to me, it looks like they're really trolling them. Like they've showed up here in March and April of this year. We've seen Deutsche Bank, HSBC, JP Morgan Chase, and Standard Chartered Bank. So these are all the big bullion banks have all of a sudden showed up in China saying they're looking for cooperation in that market. And we know that you can't export gold from China directly. You can only export gold from China if it's first brought into China and held in the Shanghai Free Trade Zone. And then you can export it. But you can't legally export gold, but you can export silver.
Yeah, I was going to say silver is a different case, right?
Right. So that makes us say, okay, well, these 4 massive bullion banks that have showed up in China, and by the way, Jamie Dimon, the CEO of JP Morgan, is in China today as we speak, first visit in 4 years. And he's announced the fact that he's going to be retiring sooner than anticipated. That came out last week as well. But the fact that we've seen these bullion banks showing up in China and the Shanghai Gold Exchange is advertising it gives you a sense that there's something cooking off. And I think just by a process of deduction, we have to say, well, they have to be interested in silver because gold is not exportable. There's no benefit to trading gold there. By the way, just a quick snapshot of the difference between the Shanghai Gold Exchange, where you have to deposit a bar to trade it in the market, in the spot market. They trade in a day a little over 300,000 ounces of gold in the spot market on the Shanghai Gold Exchange. Now, compare that to 200 million ounces of gold being traded a day in London, and it gives you a sense of the disparity between a paper market and a market where you have to have a bar deposited in a vault before you can trade it in the spot market.
Right. Well, it seems like such an intentionally complex system at this point because they need the metal to cover for their positions that they have.
Yep.
And yet the positions that they have are also in a way threatening them when these prices climb.
Right. So you can satiate demand for gold when you're delivering paper gold, and you can do that for a period of time, or with paper silver, you can do that for a period of time. But then when the demand shows up, because of the leverage, because of the huge size of the positions that you have in paper, very, very small percentage need to ask for it, and the whole thing comes unraveled. And I think, back to your original question about the price action, I think that's why we're starting to see the price move up here. We're seeing the inventories plummeting in China. They're down 70% over the last 3 years in terms of the silver in the vaults. And I think today it's about 754 tons versus about 1,150 tons at the Shanghai Futures Exchange, just 6-8 weeks ago. So we're seeing a massive drawdown in these vault holdings of silver while these bullion bankers are visiting there. And I think that we're guided towards that there's a crisis in the silver market, and we can see it. We can see how that could arise when you realize that, we've got a 265 million ounce deficit this year. They've been drawing down these inventories in London for 3 or 4 years, but they seem to have bottomed out. They're not decreasing anymore. They're holding at around 800 million ounces of silver in the London market. So it looks like they're reaching their limits of the silver that's available in the London vaults, and they're turning to other sources of it to try and meet the demand that they're facing from the promissory notes.
Mm-hmm. So that was another point that I wanted to kind of go over with you, is this idea of the drawdowns. And we're seeing it in the West, we're seeing it in the East, but we're also seeing it in the ETFs. So is that another source of metal that you think, because being obviously probably authorized participants, they're able to get metal out of the ETFs, and we have seen basically drawdowns across the board. So is this just all of these different participants trying to hover and get the physical metal in their possession?
Yeah, I mean, the big banks are authorized participants in the SLV ETF, which is the biggest of the ETFs. It holds about 430 million ounces of silver. They could, ask for what are called baskets and then get tranches of silver out of it. But you're also facing the opposite demand from retail investors that are heading in. So yeah, for sure, the ETFs can be a source of metal for the large banks, but you face limitations if you want to draw down the physical metal that's there, because the leverage that you have in the system, the claims that you have on the remainder increases as you draw down the silver, right? So if you've written a bunch of these spot contracts for trading in London, as you draw down the available silver in there, your leverage gets larger and larger and larger. Just to give you a sense of the disparity, Tom, between the silver and the gold markets, the silver that's held in London, it's about 820 million ounces. It's 3.5% of the total gold held in London. So it's a tiny little market. And of that 820 million ounces, 500 million of that is ETF metal, which leaves 300 million ounces for private investors and everybody else. So given the flatlining that we're seeing at about 800 million ounces, I think we're now at that limit of where you can actually get usable silver out of London. And again, these guys pop up in China, and here we go. So the price is running in a very public way. They're highlighting the presence of the bullion bankers in China, and we see this incredible volatility returning to the market.
So going back to this comment that Jeff Currie mentioned about that, this was basically during the, let's say, 2020, 2021 silver squeeze.
Yeah.
He explained that because of position sizing, he didn't think it was possible for retail investors to actually make the silver squeeze happen.
It wasn't the position size. Like that was
the explanation that he gave, I thought.
Well, position sizing was something that would prevent a daily run, because no one entity could legally get a very large position and therefore yank it out. So I think that was one point. The second point that he had was that the ETFs that buy the silver and hold it for their clients, they don't take it off the market. They turn around and immediately sell it into the market. He called it hedging, but an ETF has nothing to hedge. Like, the job of the ETFs is to buy the silver and hold it for the client. And the client faces the risk. And Currie said the quiet part out loud is that we're actually selling our clients' metal into the market and risking it and creating artificial supply with it. And so that was the big issue. And by the way, he's no longer with Goldman Sachs. He's pursuing other opportunities, right? So he said the part which you should never say, which was, well, if you want to play along with the game, you should never say it. But he just kind of blundered along and said, oh yeah, no, the ETFs, they buy the metal, but they turn around and sell it right into the market again. And therefore the demand from the ETFs can never make a meaningful impact on the silver that's available to market by drawing it down.
So we're talking about these different centers, whether it's New York, whether it's London, and now with the Shanghai exchange, it seems that the Shanghai exchange has really added to the pricing control of both of the metals. And there's a big premium, it seems to be, especially in silver, but gold as well, heading east. So is this just sucking the metal east? And does that end up really affecting their ability to control that market as well?
Yeah, well, I think what's happening is that the fact that the metal is disappearing from the Shanghai warehouses dictates the fact that we have a limited time of price control ahead of us.
Mhm.
And that we're seeing days where 3 to 4% of the Shanghai Futures Exchange warehouse holdings of silver get drawn down. And so you can't maintain that cadence of drawdown for very long because your inventory is disappearing. So I think that's the key, Tom, is just the disappearance of metal from the market into tightly held hands, and not necessarily even tightly held in terms of investment, but the legitimate industrial consumers are needing to source metal there in terms of getting it for its everyday use.
Mhm.
So yeah, I think the key here is inventory disappearance in China and the voracious demand in China. China has its own problems in terms of its real estate's crashing, and its stock market is not looking very healthy either after a period of secular decline.
Mhm.
And so the Chinese investors as well are buying this metal, as well as the Western bullion banks who are kind of getting their nose under the tent and trying to get into that market.
Mhm.
So it just depends who's more desperate than the other. But with the disappearing inventory in China and the flatlining of the inventory in London, I don't think we have very long to see before we get a pushing to the side of the promissory note pricing system and the influence of supply and demand asserting itself into the market, because the sellers will become too afraid to sell a promissory note when they know they face default from the person who buys the promissory note.
Right. Well, I find it interesting that you mention, let's say, the problems that China is facing. I had a discussion yesterday with David Murren, and we talked about the possible deliberate release of negative information like that could make China look like it is in a weaker state than it actually is. So trying to understand the accuracy of that information that China themselves releases, I think is a difficult piece of the puzzle to actually take seriously, because obviously their control over information, or any government's control over information, is very important to them to be able to control the narrative that they are able to present to the world.
Yes, I fully agree. I think globally, we are at the end stage of these centrally planned debt-based economies where they've just, they controlled the price of gold and silver since the late 80s and then went on a secular bubble blowing binge.
Mm-hmm.
They called it the Greenspan put, but it was really, faking the gold price and issuing unlimited debt.
Mm-hmm.
And what you get in the end is such a debt-addled economy that it can no longer function properly.
Mm-hmm.
And you need larger and larger and larger amounts of debt to function. But, with the interest rate now rising to over 5% in the US and a total of $98 trillion of total system debt, federal, state, corporate, consumer, all of the different debt sources,
mm-hmm.
They're adding with time as all the existent debt rolls over. You're having to roll it over at a higher interest rate, and they're adding a $5 trillion drag on a $25 trillion economy, and the math simply doesn't work. When we saw them spike the money supply in 2020, 2021, and 2022, for me, I knew that the game was over, because you'd have price inflation, and the sustainability of the debt bubble is not there when you've got rampant goods price inflation, which we have in the system.
Well, David, it just seems like there are so many geopolitical pieces that are also starting to play into this puzzle. On Friday, when the prices of the metals seem to really spike here, I saw a news story that was linked to Russia seizing some Western bank accounts. So when you see these news-driven catalysts for the metals, or, the amount of conflicts, for example, like in October when the conflict in the Middle East started, and then the metals were driven up as well.
Right.
Like, how do you look at those types of events and the behavior of the pricing as it goes into that? Looking at this behavior of the price from Friday, let's say this previous Friday, what would it have been, like the 18th of May or something like that, to today when we're speaking on the 23rd, we saw a huge spike, and then, it gets driven back down. So I guess what I'm asking is, when we see these news-driven events, that seems to not really provide a sustainable move for the actual metals.
Yeah, we still are in a paper pricing regime. The fact is it's breaking down before our eyes. So you can still on a day-to-day basis influence the markets and, cause divergences in pricing action from prior trends, right? But ultimately, physical shortage is there. I do think it's interesting. Like if we look at this big picture wise, City of London has been running a global gold and silver fraud since 1986, since the Bank of England took over their market and they started trading promissory notes. And what's happening is that system has been visibly breaking down to us, increasingly visible to the public, but for certain visible to the insiders that they knew that it was unsustainable. And it's interesting that, the conflict between Russia and Ukraine has been largely pushed by the City of London and by the UK government and former prime ministers. You got David Cameron in there agitating now. At the beginning of the Ukraine conflict, there was a tentative peace deal signed between Russia and Ukraine, and Boris Johnson intruded into it and scuttled it, leading to this current ongoing rolling conflict that we have. So, you can say that they're not related to the failure, but you're talking about a disruption and failure of the global debt markets and bond markets and a revelation of fraud. And then at the same time, we have these operators for the City of London, Johnson and Cameron and Sunak. All of these guys are acting in a way to stimulate maximum conflict on the global stage. So I think it's almost like an exit strategy, right? You create a bigger problem so that people ignore, the problem that you're involved in and don't pay too much attention to it.
Yeah, it seems that as we're able to see more of these examples and these news events, it shows you the actual behavior of how those end up affecting the metals prices. But, on the other side of that, when we see central banks buying all kinds of gold and likely driving much of this current price appreciation, how can that affect the price of silver and even copper accordingly?
Well, I think it's not so much the central bankers that are driving all these three metals, copper, gold, and silver. All three of them are historic monetary metals, and they all ran in the 1970s when there was loose monetary policy, and they're all running now at the same time that there's loose monetary policy. Mm-hmm. So I think that what we have is that, Bloomberg was pushing the story that central bank buying of gold is actually driving the price of gold higher. But when you look at the net increase in the gold demand, in a 155 million ounce a year market, the buying by the central banks was only adding, between 1 and 3 million ounces a year, depending which numbers you looked at. So I know that the price of gold is set at the margins by the last buyer, but still, as a percentage of the total market, given some of the declines from the gold ETFs and other vehicles, what we were seeing there was the fact that the central banks weren't adding enough to be the prime driver of gold, number one. And number two is that the central banks are certainly not buying copper and silver, that we know. So, over an 8-week period, they were all running copper, gold, and silver were running, within 1.5% of each other in terms of total increase in the price of these metals. So I think, Tom, what we see here is a run into the things that you can't print as we see goods price inflation ripping through the global economy. All the money that they printed for COVID is still out there sloshing around. The people that are getting crushed is the working class, the middle class people who hold debt, and they're being flattened in terms of their ability to carry the debt. Meanwhile, the financial markets have continued to run higher, and those who hold assets have done quite well in this scenario. But the path that we're on is unsustainable socially and economically. And I think certainly given the fact that we see this shortage showing up in the silver market and these markers in terms of bullion bankers showing up in China with hat in hand looking for cooperation from their exchanges, it tells us something. And I think we are in the end stages of the ability to modulate the price of silver. The total amount of money that's in the system is up 14 times since 1980. The total M2 money stock, which is out there, is up 14 times. And silver is trading at 60% of its 1980 high price. It tells us something, right?
Yeah, absolutely. So, David, is there anything else that we can look at, whether that be lease rates in London or anything like that, that can give us clues to how tight this market actually is? Or is this something that is just going to one day go limit up because of the amount of people that need to cover their positions?
The lease rates would be very valuable to see. unfortunately, Dresdner Bank and some of these other banks used to publish the lease rates, and they were very, very useful to see the inside story of the physical demand. But over approximately the last 10 years, those sources of lease rates have disappeared. And they can now approximate it with the futures market, but it's not totally accurate. It tends to understate the true lease rate in terms of physical availability of metal to the market. Mm-hmm. But the key thing I'm watching is the drawdown of the Chinese vaults, both at the Shanghai Futures Exchange and the Shanghai Gold Exchange. It's going to tell us a story. Mm-hmm. And also watch the vault holdings from London. I'm not certain that those are reliable, but they're certainly an input. And they have spoken to the apparent lack of availability of additional silver to the global market at the current levels, because they haven't gone up or down for the last 3 or 4 months.
Mm-hmm. I remembered another question that I wanted to ask you about how these central banks are actually sourcing the metal. You said that it didn't really make the equivalent demand in the market. So is there another way that they're sourcing this metal, or how do we kind of square that circle of understanding how that metal is being, if it is being sourced and bought by those central banks, and how we can understand that situation if it doesn't make the equivalent volume within the actual markets that we see?
So the point I was alluding to was the fact that the central banks, when they're buying in the market, are buying in the market, but that there was other entities that were selling, like ETFs had drawn down and were notionally selling the metal that they held in their vaults into the market. So the net demand was not being appreciably affected by the central banks enough to explain the extraordinarily strong run on gold that we've had in 2024.
Right.
So there is another school of thought that central banks are not buying openly in the market. So there's 6.8 billion ounces of silver above ground. And when I say in the market, I meant on the exchanges. So there's 6.8 billion ounces above ground. It's a lot of gold. Mm-hmm. And you don't necessarily have to buy it on an exchange to get a hold of it. So the sources of the central banks, I'm not a player in that industry in terms of sourcing bullion in volume like that. Mm-hmm. But there would be numerous sources. But my point was simply that we're not seeing on its face, in terms of what the central banks are acknowledging that they're buying and the net change in the annual demand for gold, enough of an explanation for the run up in the gold price that we've seen.
Mm-hmm. And David, you and I have spoken before about this, silver possibly being maybe the kryptonite to the debt system. How does that end up kind of working?
Yeah, I mean, I think silver is a linchpin to the market rig of gold and silver, and platinum and palladium for that matter too. They're traded as promissory notes. And the thing is, with silver, there's 25 billion ounces above ground, but it's not in the correct form for delivery on the exchanges. Mm-hmm. It's not in refined 1,000-ounce bars. So scramble right now is for 1,000-ounce bars. And the London market, the LBMA has announced that they're accepting silver from 2 additional Chinese refineries. They've announced that this year, one in February and one in May. Mm-hmm. So the key here is that the drag on the market from the physical demand is putting a limit on the ability to contain the price with digital contracts. And if they lose this digital pricing control with promissory notes, you could easily see silver go up, 3x, 4x in a very short period of time. Silver is a giffen good, so the higher the price, the higher the demand as investors pour into air quotes, a hot sector. Mm-hmm. The problem that these central planners have is that they're trying to implement a central bank digital currency and a social credit system to control people. Mm-hmm. And with 25 billion ounces in the hands of the population out there, if silver starts to move to, $100, $200, $300 an ounce, which I personally think is entirely possible. Mm-hmm. If it starts to move to that level, those 25 billion ounces that are above ground are going to start to circulate. That frozen block of metal is going to start to rotate through the economy slowly at first, and then at an increasing pace. And it gives a fantastic alternative to these government garbage currencies that they're using out there right now, which is a debt-based currency or a equally garbage-laden central bank digital currency, even if it's backed by gold, because of the loss of privacy and the ability to implement total control on your population. So I really see, Tom, this battle for control of the silver price as being a very, very major hinge point, both in the markets as well as politically for many generations to come, because it'll dictate whether or not they're able to implement this central bank digital currency control system.
Yeah, I think unfortunately, nobody has a crystal ball, and it's going to take time to see how all of these dominoes end up falling and what ability these governments, the debt-based systems, all of these different entities are able to grasp at to either retain control or to try to keep a lid on a lot of these different markets, whether that is the bond market, whether it is by extension, the value of their currencies. And it's interesting to try to understand how the price of the metals can affect all of that as well. And I think it's just going to take time for this to play out. And
yeah. And if the bullion banks, like if you look at Deutsche Bank, HSBC, JP Morgan, and Standard Chartered, I mean, these are big, big banks. Mm-hmm. And if they've sold, 1, 2, 3, 4, 5x times the actual metal that they hold, or even more, because once you start to rehypothecate metal, there's no limit to the number of times that you can do that. Mm-hmm. And if there's 2, 3, 4 billion ounces of silent metal in the market out there, of silent paper metal in the market out there, every dollar that silver goes higher, those are losses faced by the banks on their balance sheet. And at some point, they're going to try to cover, they need to cover and acknowledge the loss, even though they may not want to. Mm-hmm. And you could notionally have implosion of these very, very major banks happening, Tom. And that would basically lead you immediately, any of these big four banks that we've discussed, if they end up going sideways because they've defaulted on these silver contracts, it can literally disrupt the global financial system and certainly the economies of Europe and North America.
Mm-hmm. Right, because of the positioning of those banks and then how that ends up affecting their customers that had, possibly nothing to do with anything in the metals, right?
Yeah. And a billion ounce short, as the price of silver runs up by 10, 20, $30, it becomes real money all of a sudden. Mm-hmm. Right?
Consequential money for them.
Yeah, it becomes material. Mm-hmm. Right? I mean, you look at the earnings of these banks versus, 20, 30, 40, $50 billion losses, and it starts to affect them. Mm-hmm. And if they're actually defaulting on delivery, and then it becomes apparent that they've been actually selling ETF silver into the market that they had no right to, that's actually a fraudulent transaction, it can bring down these major banks. Mm-hmm. So they're fighting both for their financial lives and fighting to stay out of lockup, out of prison for some of these executives. Interesting that Jamie Dimon announced on the weekend that he's going to be retiring earlier than anticipated as mm-hmm. all this is going on.
I find it interesting how you say fighting to stay out of jail. As we saw in the 2008 financial crisis, really nobody faced any kind of jail time. So I find it hard to imagine that would be a realistic consequence for some of these bankers that have run these systems the way they have.
Well, the bankers after the 2008 crisis, everything got papered over. Mm-hmm. Like Ben Bernanke went wild with money printing, and he solved problems temporarily with printing money. Mm-hmm. But if you have a disruption of the global financial system and global currencies, and you start having, mortality events and things that can come from that, mm-hmm. I think that people are going to be much less inclined to forget. And yeah, I think that point, then you do end up having real consequences.
Yeah.
People are happy, watching basketball or hockey or whatever and ignoring reality as long as they can feed their families. But when there's disruptions of that level, or they're thrown out of their homes, and it's visible that this was caused by a massive global fraud by very, very few players, then I think it's a different story.
David, as I do this show and I meet people and I interact with the audience, it always occurs to me how unfortunate it really is that, a good amount of our audience and the people that listen to this show understand these topics and understand what can happen. And it frustrates me that it's so hard to reach a bigger audience to help, mainstream people that don't necessarily pay attention to this, but can absolutely be affected by it, to be able to reach them and just be able to shed some light on some of these situations. It's such a difficult idea to be able to A, explain, and B, help them understand that it can actually happen.
Yeah, the reach is a challenge because the media is so controlled and unwilling to discuss material matters that are very important to people. But I think that when this control, and I say when, not if, because they are going to lose. This is so far advanced in terms of the silver market that they will not be able to control this failure of this fraudulent market. Is that when that happens, you will see private money, not debt-based currency from government, but private money start to circulate again. And then you will see a tremendous improvement of the quality of people's lives. But we're going to have to go through some losses to get there first. But I think that the positive note is that once we've gone through that very difficult period, that there'd be a much brighter future. And I think after that, a much more attentive and alert populace, because when people understand the consequences of ignoring things and just thinking, well, if I just ignore it, it'll go away, the consequences ultimately come home to roost. And it's a very good lesson for people to pay attention and stay on top of these central planners who, throughout history, create destruction when they're given control of things.
Absolutely. Well, David, as you mentioned the idea of this controlled narrative within the media, share with us some of the places we can find you. You tried to stay away from some of the main platforms. We discussed last time how you ended up getting kicked off of Twitter and why that was, but
and LinkedIn,
Getter, Telegram, getting kicked off of LinkedIn as well. I didn't know that was just overly possible.
Yeah, right. I mean, for posting, what I thought was not objectionable, it was just objective information. So you can't do that. The best place, I'd say the best single source of information is my Substack. So Jensen David, so JENSEN David.substack.com. And I post there once or twice a week, sort through the data as I see it and try to create a conversation there. So I think that's the best single source. I'm on Gab as well. Post
David Jensen.
And then on Reddit as well, you can look me up there. I publish under name JStars, but I'm on the silver boards there posting information. But in terms of, cohesive and coherent information, I hope it's cohesive and coherent. The best place to find is on Substack.
Well, a lot of the articles that you put on Substack are just digestible, understandable kind of tidbits that, you don't have to sit down and take a huge amount of time to a huge investment in your day to have to
I think
through.
Recognizing, people's, including my own, ability to sit down for hours and read things. I thought that the best way to do is just make it material and make it as short as possible so that people can implement it and use it in their daily thought process and then just move on. So.
Absolutely. Excellent, David. Well, I really appreciate the chat as always and look forward to hearing more about these developments as they happen.
Great. Thank you for your time, Tom.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.